So, AJ, the VIX, this is something we've been
Mhm.
talking about a handful of times. And with yesterday's pop or drop, did it looks like we did see that correlated with the VIX, but we're kind of right back there at those lows in today's session.
Yeah. So, just a review for everybody. This VIX volatility index, it's a measurement of investor confidence versus investor fear. And it's correlated based on the demand for options, right? Because investors use options as a way to hedge or, you know, cut off the risk of anything that looks like it's going to get hairy in the next couple of days. So if all of a sudden there's an increase in demand for options, it registers with the demand of options causing option prices to go higher, and that reflects in the VIX, right? The VIX shows when option prices are going higher when all of a sudden there's an increase in fear. And conversely, the VIX will drop when people think they don't need options, they don't need the protection that they offer, and therefore they're foregoing that kind of insurance. So, with that said, I want to, back up a little bit. If I show you a chart of the VIX all the way from when the VIX was put together in the 1980s, you'll notice I've got a neat little linear regression line. That's this white dotted line that we've got here. And that's the mean or average of all time, right? And it's around $19. Um, you'll notice that as the VIX gets lower, it kind of goes. I don't know if I was to draw on the screen. I don't have my markers up, but I'm going to bring my markers up. Takes a second to load, but while we're waiting for it to load, it goes like a certain amount down, and that's where it bottoms out. That's the measure of confidence. When there's confidence, the VIX goes down. And then on the other side of the mean line, that's when the VIX goes fearful, right? That's when people are afraid or scared, right? And you'll notice that it's not equal. The confidence as investors, as human beings, we only get so confident. But when we get scared, folks, we get really, really scared. And so there's a trade that we can do here that we're going to talk about that actually uh, um, it actually goes off of that concept that we only get so confident, but when we get afraid, we get really afraid. So if I bring ourselves back to the present in this chart instead of looking at all time, just looking at the last 3 months, or even a little bit further than that, looking at 6 months, you'll notice that, we've been getting confident and then getting afraid. And so I have a trade that I do every time we kind of get overconfident. So the last time we did this trade was here. I did it here, here. So every time we kind of bottom out on this confidence scale and we're coming to a bottom here, I like to place this trade and I call it a portfolio hedge, right? Because I've got a bunch of trades going on in my portfolio, and even premium selling trades are not inoculated completely from when all of a sudden there's these moments of just unbridled fear that attack the markets, right? So, a way to hedge to make sure that even if those trades somewhat go against you, that you have trades that are going for you, or at least one of these trades, we do this VIX trade. So let me explain it. We create, we do two strategies. We do two vertical spreads. We do a vertical spread that looks like this with a strike price here and a strike price here. And then we do another vertical spread that looks like this, right? With a strike price here and a strike price here. And so if you could imagine, so long as the VIX stays in this price range, these two vertical spreads are basically going to cancel each other out. And we try to price them. One we would do as a credit spread, so it would give us a credit up front. One we would do as a debit spread so that it, costs us money up front. And we would pick them such that they would cancel each other out. Usually we try to make it so that there's a little bit of extra pennies in there that'll pay our commission for the whole trade, right? So that if the VIX stays between these two strike prices, basically it's a break-even trade. Great. If that happens, the rest of our portfolio is going to be doing well. And we don't really worry too much about the VIX going south, especially if we buy it on these bottoms, because we know that that means that investors are getting more confident. And we have just discussed that humans only get so confident, but when they get afraid, they really get afraid. So that's where this really pays off. If there is a moment of fear and the VIX shoots up in price, all of a sudden this trade goes from break even to like max profit, like almost 100 to 1, 98 to 1 is what it paid last time. And so what we want to do is we want to think about, since we're at this bottom here, we want to think about two things. Number one, what would signal us to tell us that we are at the bottom and it's time to place this trade? And again, as I mentioned earlier in the show, we're kind of fond of lagging indicators here. You can go and download our free indicators. We've got free access to our web portal where you can have access to these indicators. You can install them into your charting package. And so one of those ones that I like is the moving average crossing. So if you just do this, and this one's really flexible, right? It allows you to use different prices, not just the closing price, in order to calculate, your moving averages. You could pick what kind of moving average it is. It's not just stuck on one type of moving average. You can put a couple of different filters in there if you really want. For this, I would actually take the filters out, and I'd use my 3 and 5 exponential. I'm going to go ahead and show you what that looks like. So you can see that we got a moving average crossing, and today it's already kind of reversing. These would be considered end of day signals, by the way. So if you get an end of day signal, you'll want to have some sort of follow through that you look for the next trading day before you actually place the trade. So that's question number one. What's going to tell you that we're down at the bottom and it's time to place this trade? And number two, what's the structure of the trade? So if we, for instance, take a look at some of these strike prices here, and you want to go, maybe you could use weekly options, but you want to go about 2 or 3 weeks out. So just for laughs and giggles, we'll look at the June 18th option. And, if we do our vertical spreads here, let's see. If we were to do, for instance, a 12, 12 and a half, we could see that that thing probably costs us about 30 cents. And so we just come over here onto the credit side and we look for one as well. There's one here. Let's see. There's all kinds of things that you can play around with. And so, again, you can go through some iterations. The lower we can get that fear one and still have it compensate that one, I would say do like an 11.12 or 11.50.12. Whatever you can do here to get that to break even or give you a little bit of credit, that's the options that you would want to choose. So again, I usually do a credit spread down on the bottom and then a debit spread at the top, and just make sure that the credit spread is a penny or two heavier than the debit spread. You're going to have a trade that's just either going to do nothing or it's going to pay back, loads if there's a fearful moment over the next 2 or 3 weeks.